Great.
for the recording.
Yes.
Okay. Hopefully it's working. So has everybody gotten the blue book, the governmental accounting and auditing and financial reporting? I think everybody's been buying the digital.
Digital, yeah, we do have the digital copy.
Think so.
Okay. Should get that ordered. Can order it from GFOA.
I'm having trouble accessing mine to get on. But
Okay.
with my new laptop, but I will figure it out.
Yeah, need help, we can talk to Bill. So anyway, it's kind of the Bible for, hopefully we're still recording. So chapter 1. So when you talk about government finance, which is kind of the generic way to look at this, it's budgeting, and capital planning, debt management, fiscal policy, economic development, investment and treasury, retirement, accounting and financial reporting, and audit. And so this team tends to focus on accounting, financial reporting, and audit. You also need to have some understanding of every other aspect of this. So Kevin and Elena and Lorenzo have done work in the area of debt management, and have had some exposure to that. Budgeting, we try to make available that Department of Revenue training and the TSCC training to get some basic understanding. But that's important because, like this morning, I was meeting with our budget office about some issues with parks and Peabody. So I have the advantage that I spent like 12 years as the budget director of a small city. Cynthia has some exposure to capital. And we need to do more in the area of policy development. Or working on the least one right now, so that's kind of interrelated with that. We don't do a whole lot with investment and treasury, because we have treasury people who are experts in that, but we have a $3 billion portfolio that has to be managed to maximize our earnings. And that's a balancing act because we have to make sure we've got enough money to pay the bills. The payroll comes up every 2 weeks. AP, when big things come through, they have to let Michael know, so he can plan to make sure that he has cash available to actually make the payment. So he's got a constant juggling act going on, trying to make sure that we have cash available to pay the bills, but then we've got as much possible tied up in bonds. So that's big. Retirement for us, it's handled through PERS. But Svetlana does a lot of work with the accounting related to that and the reporting related to that. But then we also have PB&R, so we've got an entire city bureau that's doing nothing but paying pensions. And it's important to have a solid understanding of that and how the interrelationship of everything works with that. So one upside of interest rates going up, for instance, is that for the actuarial analysis of our pension liability, that is based on the present value of the future cash flows. And we use the geo bond, AA, I think, geo bond rate in order to figure out what interest rate to use for that discounting. And the higher the interest rates are, the lower our liability is. So we actually should get a reduction in our liability this year, just simply because interest rates are going up. So understanding how each of these things interrelate it is an important part of what we do. Accounting, accumulating financial information and posting to in our case, SAP. We've got the monthly report that Lorenzo helps with to report to management. But each of the bigger bureaus also has management reporting that they're doing. So like Water Bureau has a whole bunch of reports to go out every month to their people to help them manage development services. They're constantly monitoring construction permits and construction activity because that directly relates to how much money they have coming in and what kind of staffing that they have to have. So there's a lot of internal management, and this gets back to data visualization and where we're lacking there. And in our group, PBOD, for instance, and Parks are doing quite a bit with Tableau and data visualization to report to their management. Reporting to citizens, we kind of have dropped the ball in the last couple of years. We're doing a popular annual financial report to try to reach the citizens. Investors, that's what the ACFR is all about. They are the primary users of the ACFR. And that has to get uploaded to Emma. So anything related to our debt, that has to be uploaded onto Emma on a regular basis. So anytime we're going to be doing a bond call, it goes on Emma. Anytime our ACFR comes out, that goes on Emma. There's an annual report that the debt office has to put out, which talks about every one of our bond issues, and that has to go up on Emma. And that's where investors can go and do research on us. I'm kind of behind on it, but I get reports pretty much daily from Emma related to the CUSIPs that are related to our bonds. So every bond has what's called a CUSIP number that identifies that particular bond. And so every time somebody buys or sells one of our bonds, there's a reporting that comes out and says, okay, a transaction happened today with these particular bonds. So anyway, lots of stuff happens on Emma, and that's all related to our investments. And we got 3 billion of bonds outstanding. So at one point, I didn't really think of governments having investors, but the people that own our bonds are investing in us, and they're making a bet with their savings that we will actually repay them. Regulatory bodies, we file the ACFR with the Secretary of State. And they do a lot of monitoring on that. And Amy John runs that particular office in the Secretary of State's office. I've done it, and Kevin's done it, and thanks to Donna did it this year, but we have to file with the US Census. And it's a really weird form, and it's basically slicing and dicing the ACFR in weird ways that the feds want it. For a while, we were doing separate financial statements for hydro. In alignment with FERC, which is the Federal Electrification, something. It's they got a separate set of accounting standards for electrical companies. And so we were having to convert hydro into the FERC accounting and doing the report on that. But since we changed, since the contract for the sale of electricity changed, we're no longer having to do that. Need to be able to analyze the data for a variety of levels of purposes to enable decision-making and to demonstrate financial stewardship. And that's something that we need to, analytics is something we need to up our game on. Because there's just a lot of things, if you don't really, like you were digging into Fund 401's miscellaneous revenue and trying to understand what that was and why. You just have to be able to go in and understand what's happening. And I think it's fun. I like puzzles. And to me, that's what basic analytics is all about. It's just you get this giant jigsaw puzzle and you're trying to put the pieces together to come up with a picture that tells you a story. So we will work on that. And we need tools. ERP systems are basically a transaction processing system. They aren't really designed to be analytical processing systems. So you really end up needing to have additional software that does analytics. I'm hoping once we get to S4 and move into artificial intelligence, that it will be more of an analytical engine instead of just a transaction processing engine. But in the meantime, we can look for other ways to get what we need. Chart of accounts. So we got 3 bases of accounting we're running simultaneously. And those, okay, so you've got, in accounting theory, you have measurement focus and basis of accounting. The measurement focus tells you what are you going to measure. The basis of accounting tells you when you're going to measure it. So proprietary statements, government-wide statements, fiduciary statements are all on economic resource measurement focus and accrual basis of accounting. Now, a lot of times people will just say accrual and modified accrual, but really you have to factor in measurement focus because that tells you what exactly it is you're measuring. It's just like the new reporting model that GASB is working on is being called the short-term measurement focus and accrual basis of accounting. And what we're going to have to figure out is how you shift from the current financial resource measurement focus, which is what we're using now for governmental funds to that short-term measurement focus. Switching from modified accrual to accrual will also be challenging. So for us, our gap-based governmental funds are current financial resources measurement focus modified accrual. All of the budgetary schedules, regardless of what fund type, are current financial resource measurement focus modified accrual. Now, why we say we have three bases of accounting when two of them are modified accrual is kind of gets back to why GASB is wanting to change measurement focus for governmental funds. And that modified accrual really doesn't have a solid conceptual framework that it's sitting on. And there are also alternatives that you are allowed to make choices between. So, for instance, for us, inventory, you can either report, you can either handle inventory on the purchases method or the consumption method. So the purchases method is what we use for budget. So the moment we actually buy inventory, regardless of whether it goes into stores or into a job, we report it as an expenditure. For GAAP basis, we use the consumption method. So for GAAP basis, when you buy inventory, it goes into stores and is an asset. And it doesn't actually go down into the flow statement and become an expenditure until they actually take it out of the stores and use it. Now, we have also made some non-GAAP basis changes to our budget. For example, when housing makes a loan for GAAP, that's a debit to loans receivable. But for budget, it's an expenditure. And similarly, when somebody repays that loan for GAAP, it's a credit to loans receivable, but it's a revenue for budget. Now, when we switch to the short-term measurement focus, we'll be doing GAAP the same way we're doing budget now.
I have a question. Is that the reason why we created a contra account?
And so like every time we make a loan, it has to be a four-legged entry. So we're debiting notes receivable, we're debiting expenditures,
Then
we're crediting cash,
and
we're crediting an offset account.
right.
And then if we're doing budget, we pick the expenditure leg and the cash leg. And that those are the two entries that exist in the budgetary basis of accounting. We're doing GAAP, we use the note receivable in cash, so it's purely a balance sheet transaction. But in order to make it a balanced entry, we have to have that offset account in there. And it's similar when we receive the proceeds of a loan. That we debit cash, we credit loans receivable, we credit revenue, and we credit an offset account. And then we pick the two accounts that are relevant for the basis of accounting that we are dealing with. So there's some little oddball exceptions like that. And it takes some time to really get a strong grasp of that. And that's why the housing funds have had a history of going out of balance, because the accountants over in the Housing Bureau have not necessarily done all four legs of the transaction. So like, if all you do is debit expenditure and credit cash, well, one of those and your debit there doesn't exist for GAAP. But cash does exist for GAAP, so you've now just thrown your GAAP basis financial statements off
Right.
by making an unbalanced entry. It sounds like it's getting better, but there was a time when those funds got out of balance regularly because you weren't getting all four legs of that transaction. Now, similar things happen in debt accounting. So like when you sell bonds, you're debiting cash, you credit bonds payable, but you also debit an offset account and credit proceeds.
For
Because on
the revenue
in
account.
modified accrual, you don't have your its current financial sources in a bond, long-term bonds payable is a current financial anything. So bonds payable don't exist in that measurement focus. So you're not measuring bonds payable, actually you're not measuring capital assets in the current financial resources measurement. So you have to kind of look at what assets and liabilities exist in different measurement focuses. And then you also have to look at the basis of accounting too. So like with modified accrual, in order to recognize revenue, it has to be earned and it has to be available. Where for accrual-based accounting, it just has to be earned, and then you recognize the revenue. So anyway, you get into a whole lot of that sort of stuff, and let's see if my hyperlink works. No, it doesn't give me the.
Kevin won't
the
give you the password.
So we have to do read only.
I can't give it to you.
So this gives you kind of an idea of what our chart of accounts looks like. So there's assets, liabilities, equity, revenue, expenditures, internal. So if we're looking at cash as an example, it's got a governmental group code, so it exists in current financial resources, as cash is a current financial resource. It exists in the proprietary basis, in proprietary funds, because it's an economic, it's in the economic measurement focus. Similarly, in fiduciary funds, it's got a fiduciary fund F code, and it's got a governmental activities group code, and it's got a business type activities group code. But then you get down into these next accounts, and they only exist in the treasurer's fund, which doesn't get reported in the financial statements. So really, it shouldn't have a gov or BUS, because it doesn't exist in any of the financial statements. And you can kind of go through. So taxes receivable, again, exists in all bases of accounting. So now there isn't a P code here, but that's just because there are no taxes in the proprietary funds. If we were to have a tax in a proprietary fund, then we would have to add a P code. But here we just need a G and F and the gov and the bus. So you can kind of go through and study this, and then we've got some explanations out there. Liability is the same way, equity. And The 31s are where accrual basis accounts close to. The 33s and the 34s are where modified accrual accounts close to. 36s are the ones that we use for setting up financial statement presentation. So for a governmental fund, fund balance can be non-spendable, restricted, committed, assigned, or unassigned. So when you're doing your fund book, you'll go through and analyze and figure out how much of your fund balance belongs in each one of those buckets. And then you'll do a presentation entry to get that set up. The 390s are weird. So when we make a capital, spend money on capital assets, it will, see if I can remember all the, it'll debit one of the 177 accounts, and it'll credit a 597 account.
597 or 590?
595. It credits a 595 account. And then it debits a 171 account and credits a 597. And then it debits the 390, or credits the 390 and debits the 562s. So you should be able to add up the balance in all the 390s and the balance in all the 177s, and they add up to zero, because they're just kind of in there to be offset accounts to making everything happen the way we have to have it. Because we have to, the 171s are the capital asset accounts, so we have to have capital assets for accrual based.
Mhm.
The 562s are our capital outlay accounts for governmental accounting. The 595s are interesting in that they offset other types of expenditures. So if somebody is working, an employee is working on a construction project, their time will be charged to a WBS element on their timesheet. And it will hit a 5-1 account, which is our payroll, is the 5-1s. But since it's capital, we don't want it to be personnel cost. We want it to either be a capital asset or a capital outlay. So there is a 595 account that has a credit balance that is grouped with the 5-1 accounts to reduce personnel costs.
Mhm.
So you have salaries that end up being net of whatever was capital related. And then the capital related cost of that payroll is either going to show up as a capital outlay or as a capital asset, depending on the basis of accounting you're working in. So spending some time in here and getting a feel for how all these different accounts work with each basis of accounting becomes critical because it can get tricky. So let's see. Trying to remember. So developer costs. Developer contributions are where some developer puts in sewer, water, streets, whatever as part of a subdivision. And they are required to give us those assets. So it's not a cash transaction. So no current financial resources have changed hands, so it doesn't, that transaction doesn't exist in modified accrual. But we have to show the revenue in accrual-based accounting. But because of the way the system works, when we record the capital asset, it actually ends up debiting capital outlay, which is an expenditure for modified accrual. But since that transaction doesn't exist in modified accrual, you have to somehow get rid of it. And the way we do that is right here, where this G code groups it with capital outlay. So by grouping this revenue with our capital outlay account, it reduces capital outlay, so the capital outlay is right. But for proprietary funds, or anything for accrual base, it's actually showing up as a revenue.
Mhm.
Anyway, that's why it's kind of important to get a real feel for how all these accounts, what they do and where they fit into the big picture. The 487s are weird. We never use them. And there's no actuals charged to them. They are a mechanism that the budget people use for allocating discretionary money within a fund for budget. So accounting doesn't have any real revenue streams to speak of. We have a little bit of internal revenue, but not much. So we appear to have a unbalanced budget because we got lots of expenditures and very little revenue. And that's not allowable. You have to have a balanced budget everywhere. So the way that gets fixed is that the budget people allocate a certain amount of the general fund discretionary money to accounting to balance our budget. And basically what general fund discretionary is property taxes and other revenue streams in the general fund that aren't earmarked for a particular purpose. So 487s are a little bit weird, but if you're a budget person, they're relevant. 488 accounts pretty much belong to us, and really, unless they've gotten permission from us, nobody should be using them. They are ways that we play around with presentation. And manipulate things. So, for instance, if you had it, it's probably not. I can't think of a reason why it would happen. But parking fees was a negative, or a positive number. That wouldn't be something we would want in presentation because you would have a revenue with brackets around it. So we would probably want to move that and bury it in like miscellaneous revenues. And so you could use the 488 accounts to move the revenue from one spot in the financial statements to another. So anyway, we've got a bunch of 488 accounts that allow us to manipulate things. Similarly, we've got 588 accounts that allow us to move expenditures around. Basically, the 5 ones, like I said, are personnel. 5.2s through 5.4s are external M&S. And then we go into debt service. And then capital outlay. And then the 5.6.5s are accrual-based depreciation accounts. The 5.9.7s are offset accounts, 5.9.8s are mostly offset accounts. Internal. These are accounts or ways that bureaus can move costs around. Like if they charge somebody's wages to general fund, but they really wanted them over in the golf fund. They could credit one of these accounts in general fund and debit it over in the golf fund and move those personnel costs over there. And these are similar type things. 6.4s are internal revenues and cash transfers. And then the 6.5s are internal expenditures and cash transfers. And they're corresponding. So for the 6.5.1101, there's a 6.4.1101. So when you do an interagency billing in the fund that's doing the work, they will credit 6.4.1101, and in the fund where the work is being done for, it'll hit the 6.5. But to make it more complicated, the way SAP is set up is in FI, which is where we do most of our work. There originally were only 6.5 accounts. There weren't any 6.4 accounts. But a number of years back, we worked with EBS and created 6.4 accounts in FI. And so when the transactions initially post, they all post to 6.5. So both sides of the transaction I was talking about would hit 6.5.1101. And then overnight, there's a reposting program that goes through and looks for a credit to any of the 6.5 accounts and repost it to 6.4. So anyway.
I'm curious about that screen specifically, and you don't have to answer this if it's too much in the weeds, but that leases account in row 208, what sort of things would go through there?
Okay, so accounting pays facilities $300,000 a year for our pupils.
Okay,
And somehow they have factored into that our usage of common spaces. So anyway, but another exclusion to GASB 87 is anything internal, where it's just passing back and forth between one fund and another, or one bureau and another. So anyway, our facilities fund owns this, well, they own 11 of the 15 floors. I think that's right. Water owns 2, BES owns 2, and facilities owns the rest. So those of us in the 11 floors the facilities own have to pay them rent. Now water and BES pay them for like water and sewer and electricity and maintenance type stuff, but they aren't paying rent. So that's what that's all about, is that interagency billings like that. So that's a real quick look at the chart of accounts. So accounting for us, there are a bunch of work order systems. So BES has, I think they got 2. And Water has 1. And I think Peabody has 2. I think there's a separate one for the streetcar. Which is basically, so Fleet has a work order system, and I think Peabody is using the same work order system that Fleet uses for the streetcar. And then Parks has one, and like I said, Fleet has one, and so anyway, there are a bunch of non-SAP work order systems that are flowing transactions into SAP. We all post journal entries. We got AR and AP modules that are pumping stuff into SAP. We got the capital asset module. Housing has a separate loan program that they use to keep track of their loans receivable. FPDNR has their own benefit system, and they actually are paying all their beneficiaries out of that system and writing their own checks. And then a summary entry gets posted into SAP. The P card system is similar in that it's done at Bank of America currently, and then once a month we pull the data down out of Works, which is Bank of America system, and post it into SAP. Treasury system flows into their CLM is flowing into there. And then Parks has their ActiveNet that they use in all their community centers, and that's flowing into here. And I'm sure there are a bunch more. So I think, and this is where EDS starts to have problems, and why they're trying to push people towards flexible real estate. Its original vision, when you go back to when we were planning for going to an ERP system when we were in IBIS, is there were over 100 shadow systems that were flowing into IBIS. And the concept was in getting it transitioning to an ERP system that we would have just SAP. And we would use SAP work order systems, and everything would be integrated into one big thing. And EBS still holds to that vision. Now, you get out into the world and there is a massive debate about this. So a lot of people argue that you go activity by activity and you go find the best in breed for that particular activity. So BES wants to get the best in breed for a work order system for handling a sewer system. And Water wants to get the best in breed for a water system. And so on and so forth. And that's kind of the direction we kind of.
Probably the disadvantage of that is in the consolidation process. When you have different systems, it's kind of difficult to consolidate.
And building all those interfaces and keeping them functional, because each one of them has upgrades. So every time one of those work order systems does an upgrade, it can potentially break the interface. So it requires a lot of constant testing.
That's true.
to validate that the interfaces are still functioning properly. So. I think we covered this a little bit earlier. So financial reporting, we got the internal. And I got some of the monthly reports. And single audit and grant reporting. Let's see, I'll bring it up. So this is our single audit for 2020. There's the audit opinion. And this is what's generally referred to as the CFA, which is the Schedule of Expenditures of Federal Awards. And it's broken down by agency. And then grant within each agency. Now, these numbers here are what's called the CFDA number. It's Catalog of Federal Domestic Assistance. So every federal grant has a CFD, unique CFDA number. In theory. I audited a nonprofit a long time ago that they would get allocations directly from Congress. And those wouldn't have a CFD number. So for those, we just kind of had to invent one. The first two digits tell you what agency. So 10 is related to Department of Agriculture.
Ron, Svetlana saying she can't see the file on her screen. It might be that the PowerPoint is the only thing shared right now.
Yeah, I only see PowerPoint, no additional files are showing up.
Okay, so I guess that's one of the problems with. Let's see if I can.
I think, yeah, hover over the teams and then select that third window there. And then do the three dots.
This one or the other window?
Maybe the other one, one of them, I don't,
It's
maybe the
the
one with
one-
Svetlana's
yeah, that
face?
one.
Okay. Oh, there it is. And then, so click on that one and then where it says more, is that what he'll want to share, right? Like the,
I usually would cancel the share and then reshare what I want. You can click where it says share next
With
to
the
the red
F.
leave button and then, yeah, reshare it and make sure that you get the screen. Right? Yeah, the whole screen instead of just a window. Did that work, Svetlana?
Yes, it did, thank you.
Okay, so that's the CFD number. So 10 is Department of Agriculture, 11 is Department of Commerce, 14 is housing. So anyway. And then we have direct expenditures and pass-throughs. So based on this, that auditors figure out what they have to audit. And if I remember correctly, if you're a low-risk auditee, they have to audit 25% of your total expenditures. So they have to pick out programs that add up to 25%. So you go all the way to the bottom, and we got $108 million of federal expected spending. So they would have to get coverage of 25 million. So that's one criteria. Second criteria is is it a type A program? And there are dollar thresholds to tell you whether it's a type A or a type B program. So they have to focus on the type A programs first, which are the really big ones. And then another criteria is that you have to audit a type A program at least once every 3 years. So, like, I think for this fiscal year, we could hit 25% probably with ARPA, which is the big federal program. That probably gives us coverage, it probably give us, it's a type A program, so we got that covered. But we haven't audited transportation in the last 2 years, so it has to get covered this year. So we may well end up with over 25% coverage this year, just because we have to pull in that type A program that hasn't been hit in the last 2 years. So anyway, that's kind of a general thing. And then here they're telling us stuff about what it was that they focused on. And then they have to fill this out. So are there any material weaknesses, significant deficiencies, non-compliance? And this is governing the financial statements. And then this is governing the federal awards. And here they're talking about the 4 programs that they audited last year. So they did home, COVID, and Homeland. And what type of opinion they had on it. And then any findings that they had. So considering what we went through that year, it's kind of amazing that there were no findings. But anyway, that's kind of an idea of what the single audit report is all about. In some years, this gets done at the same time as the ACFR, but things have been weird. So October 30th is, well, I guess we did it on time that year, maybe. I don't know, March 31st. So they didn't actually get that done until March 31st, which is the last day. You've got 9 months from the end of the fiscal year to issue a single audit report. So the first report had to do with the regular financial statements, and this one has to do with the actual single audit. We did a little bit better this last year. I think it was sometime in December or something that we got it out. So once things simplify a little bit, hopefully we can bring them back into alignment, get them both done at the same time. But so anyway, we didn't have any questions. Probably make a better training if people ask questions, but this week was kind of a basic overview type thing.
It's very helpful.
Very helpful.
And although I've been doing it for a long time, I'm not infallible, so I think I'm off base. We can all learn something.
I think I have some question. Clarifications on those accounts, non-budgetary versus budgetary, and the common mistakes that people commit when they kind of make an entry where one is budgetary and the other one is non-budgetary.
Yeah. Yeah, we should probably develop some training around that. And,
Yeah.
I mean, a lot of the people that do those entries normally tend to understand them, but we've got a lot of turnover. So there's definitely the potential for people to get sideways again. So anything that we can do, I mean, we did finally start putting that chart of accounts up on the webpage, which is something that's been asked for a long time. But actually do the training on the entries. Somewhere there is that, we can dig that out when we get to the end of the blue book and go through that.
A lot of times what we see is people will make the entry to impact their budget statement, but then forget about the balance sheet side of the entry.
And that's why our budget to actual statement is out of balance.
Mhm.
That's the common thing I saw.
Yeah. That's gonna take us a while to go through this, right? 6 slides in an hour. And there's 156 to go, or 150 to go.
Do you want to keep recording?
Huh?
Should we stop the recording or?
Let's see.
Click back on the,
Oh, it'd be back on Teams, only if you were ready to stop the recording.
back on Teams, yeah.
It could be the one with, yeah, that one, I think it's more,
Go to the more.
and then the
stop.
bottom, stop recording. Yeah. Bye.